Up team, Don wants to live here, and I've owed this for a little while. I kept putting it off because things were happening in the market. This is an update to the 2022 100K put and call premium challenge I've been doing. And for those who are new to this, basically what I want to do is prove with real numbers and some real background whether or not using a put or call selling strategy was as reliable as a lot of people on YouTube are claiming it to be, as well as a lot of people on Twitter. I see this actually very, very often where people are like, hey, you want to retire? No problem. 100K is all you need. It's super easy. That is utter and complete BS. You are being lied to. You cannot do it. Number one, alone for the taxes, but also because the amount of risk here is out of control. Now, I don't want to paint it as a pure negative picture. I'm making a lot of money doing this, but I'm using real money and recording the real trades because if you don't have the necessary capital, the risk you need to take to get to the yield you would need to generate the income to live on is very high. I'm also going to talk about covered calls in a second. There's been a lot of people who have asked me to talk a little bit about covered calls. I'm going to take just a few minutes to do that. I'm gonna talk about that quickly here, and then if you're not interested in that, or you already feel like you're super comfortable in covered calls, skip a couple minutes ahead. You won't miss anything there. So long and short, a covered call is when you write a call, or also known as selling a call, against shares that you own in your portfolio. That's the big reason it's called covered. It is not a naked position that's not supported by shares. You own 100 shares of XYZ. I want to write one call against those shares. That's what makes it covered, right? If I get called, I don't need to be protected by cash. I'll simply give up those shares. And what you're saying is, I want to try to earn income on the shares that I own in my portfolio. In this case, let's call it 100 shares. And I want to sell this premium to the market. And what I'm doing as a buyer on the other side is I'm saying to myself, well, I want to buy a call because I think that this thing is going to go through the roof. So I'm willing to pay a little bit extra to this seller to lock in pricing. So if it goes up and over that amount, the most I'll pay is just what I paid for that current price. So it's great for both parties, depending on your goals and what you're trying to get out of it. Now, the key with a covered call is if you have the ability to stretch out that call, right? If you're at 100 and you think there's absolutely no chance, there's no history, there's no way this thing's going to 105, you could sell a call where if it goes up over 105, you lose those shares. But if it closes out under 105, you keep your premium, you keep your shares, okay? The reason why covered calls can be particularly limiting, especially if you're a younger investor with a long time horizon, is if you have really big name, excuse me, my allergies are terrible today. If you have these shares of high growth companies, even in terms of like correction markets and bear markets like we're seeing right now, the odds of that thing having a wild swing and you losing those shares can oftentimes be really high, and you can lose a lot more than you're going to make on that premium and that price point, okay? So I just want you to really be thinking about this, that this is a strategy that best works when markets are moving more of a negative position or more of a neutral position, where we're not likely to see a huge jump in price. I think they make tons of sense if you're just looking to get some premium. You don't really care if you lose the shares or not. I'm going to talk about that during some of the results here that I've had as well, and how I play both sides of it. But I think it's a really important call out. Now, one thing though that I think is very disingenuous when people explain this on YouTube and Twitter, and yeah, I'm calling you out if you do this. Like these strategies work best if you have a huge amount of capital and or lots of shares, right? Because what you really want to do is be able to push out that risk as far as possible of being called, while still having enough call contracts open, that you essentially get to that same dollar amount you're looking for to survive or on. People love to do this thing where they talk about like, well, I'm just looking for yield. But the problem is you can't retire early on yield if you're yielding it off $100 or $1,000. You need to have a lot of capital so the yield is meaningful. And the bigger amount of capital and the more underlying shares, the more secure you can take your picks as far as where those calls will fall. In the case of the XYZ at 100, and I was saying you could do it 105. Well, if I have, 2,000 shares and I can run 20 contracts, but push it all the way up to 120, 110, 120, whatever the number is, the odds of it hitting that number become much less. My odds of getting called become much less, and I can keep rotating that trade over and over again and collecting that premium every month, every week, whatever the case might be. Now, one thing I want to call out as you're looking at the way I do this, I almost exclusively trade what are called weekly options. These start Monday morning, right, in theory, and they close out at the end of every week. Well, forget the Monday morning. That's too complicated. Just think of it like this. There's a closing date every single Friday at 4 o'clock in perpetuity in these types of options. A lot of options are monthly only, so just keep that in mind. Some stocks you look at will be monthly only, some will be weekly only. Two really common sort of popular stocks nowadays to be talking about are C3 Technology and Palantir. Palantir offers weeklies, C3 offers only monthlies. So just something to call out. So that's my piece on covered calls. I wanted to give like a 3-minute version of it for those who sort of get the idea, but just want a little bit of extra information on it, and also present some of the risks and why it limits your upside. If you still want me to do a real deep dive on this, or you want more information on it in general, I'm happy to do so. Just let me know, and I'm happy to lock that up and take care of it. Now let's jump into the results here, and I'm going to caveat this by saying I have tried to keep position sizing to be true to what a newer retail style investor will be dealing with, and you're going to see I know what I'm doing. I've been doing this for over 20 years. I know how to look at markets. I understand how to look at standard deviations. I know all of the math and the Greeks and everything, okay? And still, I'm getting absolutely lit up in this challenge. I'm only laughing because it's just sort of as like the proof of this is not as simple as people claim it is, and it's literally crushing my returns for this year until I get this thing fixed with the market that's in right now. But that said, I'm actually glad to do it, and I also have to be honest, if I wasn't using real money to do it, I feel like it would be very disingenuous of me to pretend like I'm doing it on paper or some bull crap like that. So I run all of these things through the trade lab within eTrade. So very advanced stuff. I can look at deviation rates. I can look at percentages of wins. I can do all the kind of math I want to do in there. And even with all of that, this market has been so crazy. I'm just getting smashed every week. Now, luckily, I wouldn't be doing this to put myself in a position where I'm financially in trouble, and you shouldn't either, by the way. But my point of this is if you don't have a portfolio that can support having to acquire tens of thousands of dollars of shares a week, and I'll show you what I do with those too, but if you don't have that ability, you're going to be in some trouble. So long story short, I'm going to kick it off here by sharing my screen, and we're going to jump right in. And I know it's been a while since I've done an update. Excuse me one second while I pull that up. Okay, so here we are. I'm going to scroll in for everyone who's on phones here. So look, we were making a pretty good run. For the first 12 weeks, my target forecast for premium was $4,325. My actuals to date, finishing up week 9, are $3,402. I'm going to take a sip of my coffee here. Excuse me. Now, the market's starting getting really, really cuckoo up around here, week 3 and 4. And so I started taking risk off the table, trading smaller positions, really cutting it down just to like super, super obvious things that I felt I could grab a few bucks on. And in my general approach to the markets and the way I invest, I'm going to be honest with you guys, like I'm not looking for $49 returns, okay? But I'm doing this because I didn't want it to be anything other than reality for what other people are dealing with. And you'll see when I go into the details here what these were and how I was basically looking just to get something on the books to try to prove out like, hey, you can consistently make money, but it's going to be wildly all over the map, and the risk has to be considered based on what's going on around you. In week 6, I got aggressive again, took a beating because of it. And then week 7 and 8, and I've got all the dates on the next screen. Week 7 and 8, things were so insane in the market. I really didn't feel comfortable putting on any trades, even just for this as an exercise to share it with people. But this past week, I started feeling like we were hitting, excuse me again, hitting some potential lows, some areas of weakness where I felt like we might stop seeing the falls. And then, of course, Russia and Ukraine start to take place. We start getting more news on that front. Futures prices are going crazy. Oil prices are going crazy. So my point is, if you're doing this for a strategy that you believe you're going to retire on without having 20 plus years of experience and understanding all of the risk math and everything that goes into this, I don't know. I think it's going to be tough. And actually, I'll put the challenge out there. If you watch other YouTubers out there who are claiming to do this full time for real retirement income on a regular basis, feel free to tell them to come at me, because I would love to debate them live and understand how they're doing this, unless they have millions and millions of dollars, and they're not letting anyone know that, by the way. That's going to be the caveat, is claiming they're doing this, but not claiming they're doing it with $2 million portfolios. It's not the same thing. So long story short, though, in order for me to hit my forecast to actual for this first quarter of the year, excuse me, I've got to do a little bit under $1,000 in the next couple of weeks. I don't see any problem hitting that number, but it is proving the point of how much more difficult it's about to start getting as I've tried to grow these numbers. So what I might have to do is start raising some of these smaller numbers and, starting to shrink some of these numbers further out, just give myself more of a chance of getting there. So here's the deal. Here's the details. So, excuse me. You can see where I start, and I'm going to be showing the day that I made the trade, the premium that I was paid, the symbol, the type of trade that it was, the strike price I executed at, when the expiration was, the size, which is the number of contracts, and then the current share price at the time that I executed on the trade. My notes and comments are sort of a shorthand for the way that I read the market. So I was thinking about this, that I do apologize that some of them may feel weird or don't make sense. Hit me up in the comments if there's things that just totally are blowing your mind and I'm not explaining well. And then also I call out here where I get assigned on these. Now you notice we start off very heavy in selling puts, right? Then I have to start selling calls so I can earn income on what was assigned earlier in the previous week. So what I wanted to do here was just catch up to sort of the common period here, because I think it's important to talk about what's happening right now for those who are following along. So where I sort of really didn't do much was January 24th, which kicked off week 4. Excuse me. All I did was sell a call against some Uber that was assigned to me. That was the $49 I made there. And as you can see here, it's previously assigned. I'm selling calls. In this case, those are literally covered calls. That was all I did that week. I couldn't find anything else that I felt good about. The premiums weren't representative of the risk. You got to know when to hold them and you got to know when to fold them. And this is one of those ones where I just decided to hold it for now. Week 5, same deal, right? These never executed, so I still held the Uber position. I wrote a premium against this, got a little bit better pricing. And what's interesting here is you can see I actually executed at the exact same strike price. But my feelings about the stock let me take a little bit more aggressive stance here. So when I originally sold these calls, it was at about $36, just about. And I was looking for a call of 38 because I actually wanted these off my books to free up that capital. Now the following week, I did the same thing, quite a bit more in premium, same call, same strike, excuse me. But now I was literally just trying to get out of this position. And because I was able to make this call so close to the current strike price, so close to the current price, it paid quite a bit more. And again, by the way, still did not hit that number. Week 7, you can see here, made a couple trades, right? These Ubers are still happening. But what was interesting is I decided to double down on this position. I had done so much research at this point, trying to dump this out of my portfolio. I just decided to sell that call where I grabbed $247, by the way, for that call. That is unheard of. There's a lot of news coming out about Uber at the time. I also saw that there's an equal yield opportunity from the put perspective. So although I don't recommend this, I decided to play both sides and just double up on the premium there. And as you can see here, on the put, I was assigned yet again. And then on the call, I still wasn't assigned, so I still was holding those shares. And I want to call this out for those who maybe don't understand the math of this. I now have to hold $3,800 worth of these in my portfolio until I get rid of them, and then picked up another $3,800 on top of it. But this is also in a sense where I'm starting to look for other ways out or other things to do. So what ended up happening was I decided I couldn't play games with selling premium on Uber. So the moment it jumped above 38, which it did, I already had something in there to execute on it and get them out of my portfolio. So I did end up taking a profit on all of these. And I would also call out too that because of all the premium I had made, my average price was quite a bit lower than where I ended up grabbing them. Here's where I started to get a little bit experimental on yield. I was trying to really factor out what I'm going to have to make to hit the long-term bigger numbers here. So I've been writing some algos around this position called TQQQ. And I want to do a full caveat here. You should stay away from this thing. It's extremely risky. It's a triple leveraged QQQ index that sort of tracks the way QQQ moves, but at a 3 times leverage. So it's great. I win, it's 3 times better. I lose, it's 3 times worse. So options, as you can imagine, now I'm not only getting that leverage from the underlying symbol, I'm also getting leverage from the option. So I was looking to make this as sort of an intraday trade. Um, you can see here that the week kicked off on February 7th, right? So Monday's the 7th, then the 8th and 9th and 10th and 11th. So if you think about what I did here, team, on Friday morning, I executed selling a put on TQQQ that I was hoping to have close out for profit at the end of the day. So this is an intraday trade. I don't do these all the time, but that 53 bucks on this position felt like such easy money at that moment. And I kid you not, like minutes after I executed, it crashed right through the floor. So again, now I was in a position where I now have to grab another excuse me, another 5,300 bucks. I'm sorry, $5,650 into my portfolio that I have to protect as well. So I want you to start getting a feel for what's going on here. If you think you're going to do this for a living and retire on this, okay? Even intraday trades on relatively light or stagnant volume within a channel of trading price, still these things are moving like wildfires within hours of me closing on it. So again, this is why I say, if people are claiming you can do this with a tiny portfolio, 100% that's complete BS. And what they're gonna tell you is it's okay. You can roll them. You cannot make a living paying your bills if you have to keep rolling things and losing profit as you go. Okay, so just please, like, excuse me, if you're learning to do this, be super careful on how you do it. This brings us up to really today's day. So the week of the 14th and 21st, I decided, like, look, it's not worth doing anything right now. I don't know what's happening in the market. It's way too volatile. I was sitting on too many things I didn't want in my portfolio, so I had to really wait and feel out what was going to happen here. So it brings us to today. So the week of February 28th, week 9, you can see I got pretty aggressive here, and I want to make up for some of this lack of premium that had been coming through. So I'll run through this pretty quick because I didn't want this video to be super long. But on the 28th, I sold put of TQQ again. Now, to be clear, I'm also writing some sort of, like, I'm working on some math and doing some modeling around TQQQ and how it trades and moves and how it parallels different parts of the market. So I actually don't mind owning these. So in a sense, I didn't really care if I was assigned these, because as long as I'm getting such a great premium on it, I was sort of indifferent towards it, to be totally frank. So just keep that that in mind here, that my strategy can sometimes be multifaceted. So I picked up a put there, got $232 a premium, which is huge, but that explains, I hope, to everyone who understands it, this is how volatile the market was. So as you can see here, I said that even though I'm paying very close to the near-term price, even a small drop here would be okay, because I'm covering myself by having such a big premium, and that did in fact happen, and the premium did in fact protect me. Now the next day, March 1st rather, I saw some movement I liked. It had dropped by about $1. So what I did is I sold more puts again, but this time at a strike of 50, and I made $143 premium there. So good sized premiums, willing to deal with the risk. I was looking at what was happening with Ukraine and Russia, looking at the high volatility, but expecting a return from it. And then exact same thing again. Later that day, I actually saw a really good price opportunity jump through. So at almost the exact same pricing in the market, I was able to sell 2 puts here, but even better premium for essentially the exact same strike price, same date, everything. So for me, it was a question of, like, look, over the course of 2 days, I grabbed $687 worth of premium on a position I don't mind having in my portfolio, because I do think we're going to see, let's stop for a second. Markets go up over time. History is not always indicative of the future. You need to do your own due diligence, risk assessments, everything, okay? Like, this is literally not a financial advice video. This is me doing this in real time with real results. My gut play is that I think that there is a mathematical error built into TQQQ that I'm trying to suss out myself. I think that it's an intraday stock that typically you don't hold overnight. I think that there is the ability to hedge this against a different non-corollary asset. I'm going to go into the weeds here a bit, team. So, if you lose me, let me know. I believe that somewhere else in the market exists a way for me to hedge this properly and design the right risk profile around it, where I can leverage both a selling put model, a long-term strategy, and a hedge to put off risk all at the same time and carry this through over the long term. I'm not even near having that done yet, and I'm really working on that. But if I get to a point where I feel comfortable with it and I feel comfortable with the hedging on it, I will share that at some point. Although don't hold your breath. That could be months away, depending on what else is going on. So then additionally, I saw the price of Square. Look, right, Square jumped up because of positive earnings. I'm going to expand this, right? I felt like the spread was great. We had some breathing room in the price. So at the time I executed on Square, again, I sold a put here. The price was at 122.82. My strike was literally 118. It had been rising. Keep that in mind. We saw a huge bump in Square. So I felt like I had good margin there. And I made almost $150 on the premium call. Now, let me just, I have to laugh at how funny these things are because it is so serious, and this is a serious thing, but you can't take it serious. Like, yeah, this is money and this is real life, but you know what? I hope you're sitting there laughing at me and saying like, oh my God, this ding dong is getting wiped out and going to have like, I'm going to have more shares of these companies than you can shake a stick at. But I'm going to talk about that in a moment too. Square today, I can't even believe I'm saying this out loud. Square right now on Sunday is 106. So I got absolutely pounded on this Square put. I'm okay with it, but this is the risk I know going into this that's going to happen. The problem, however, is if you're not okay with it. I just got assigned $11,800 worth of Square. So if I wasn't prepared to take that out of my portfolio, I would be in deep, deep trouble. Yet again, pointing to the fact that people who are claiming they do this for a living are lying about one of two things. Either their portfolio is 30x what they're claiming it is, or they're not being honest with the level of risk of what they're doing. Because I can show you a strategy to do this where I will almost never be assigned ever. But it wouldn't help you because you're not going to have the same level of capital to put into it, or you won't be able to ever get anywhere with it because the yields are too low. So just keep that in mind that like I'm showing this with really speculative assets, really crazy moving assets, because I mean, let's call a spade a spade. These things are moving like crazy. And if I want the big premiums, I have to be looking at growth and volatile stocks or ETFs or exchanges, et cetera. So just keep that in mind. But all that being said, I did get a break somewhat on my acquired price because of the premium, and I'll talk to my strategy in a moment. Now, Palantir is an interesting one. I sold puts here at a strike price of 11.50. Look, these are my notes in real time, right? The price started feeling like it was stabilizing. I felt like we were going to hit a side trend for a while, even though it was having a down day. I actually sold 5 puts here because the price was obviously low. So those 5 puts added up to $130. That gave me actually a nice little premium bit of breathing room here. So each contract was about $26, just FYI. So I got about a 26-cent discount on each share that I picked up. So just keep that in mind here. So I felt like, hey, look, even this thing takes a little bit of a hit in the day. It might drop below and I'll get assigned. But even with that, I'm going to have some breathing room. Let me give you that price right now. I didn't think of this before the video, but Palantir as it stands right now is $10.96. Here's the thing, though. I actually don't mind adding 500 shares of Palantir. I have a sizable portfolio there. I feel like I got these at a little bit of a discount. Yeah, I could have waited and bought them cheaper, but that's the name of the game. So here's the deal. Next week, here's what's going to happen. And I'll do a follow-up and you'll see the math and the notes and everything else. I am going to literally be selling calls against everything here, which is how I'm going to generate some premium off of this. I need to clear these from my portfolio ultimately. So that's the reason I'm going to be doing that. Now with TQQQ, I'm going to obviously write some calls against these right away. With Square, I'm not sure how, excuse me for coughing with the allergies today. With Square, I haven't decided how I want to play this yet. I'll probably end up writing calls. I might end up taking a small loss on Square because I just want to get it off my books and I still don't feel comfortable where it is. I will admit, based on the earnings and based on the jump in price, I can't even get my head around why it would have crashed so bad afterwards. I read every single page of the earnings, but things happen in the markets that are hard to explain sometimes. So I'm not sure how I want to play this one yet based on where it is. And I also don't mind taking some losses to offset some of the gains as well. So this is sort of where we ended up. This, for the record, is what it looks like when you do this stuff for real, right? You don't get it right. You're going to get it wrong. And the entire game of investing and trading in general is not when you do things the right way. It's what happens when they don't go the way you think they're going to go. And now you have to act on that information. So look, this isn't meant to be the most serious exercise of my career. This is just sort of a fun way that I could put some real market to work, frankly, see if I can generate an extra 100K for myself this year and show everyone here that like the risks are very significant. And if you are not sitting on at least 50, 60K of extra cash in your portfolio to cover yourself here, you're going to be in real bad shape, and you can lose a lot of money. In fact, a lot of people will and do lose a lot of money doing this. There's an old saying that selling for premium is like picking up a penny with an oncoming train. Is it really going to be worth it to pick it up? Now, because my strategy involves a lot of math and a lot of hedging, I don't mind the risk, and I can find ways around it. And I also only ever do this in companies or positions that I don't mind having on my books, or I feel are interesting for some reason, or have a catalyst that makes it feel like something I don't mind holding on to. If you're doing this purely as a play to survive on the income, no, it's not going to work out. Okay, I get it. Like, everyone wants to retire early. That's the coolest thing in the world, and we all have to do it as soon as possible. This is a way to, not only are you not going to retire early, you're going to end up probably bankrupt and in big trouble with a lot of people. Because once this money is gone and you are completely out of leverage on these positions, you are now having to sell at massive losses. And the ability to make up that amount of income or capital when you're retired, it's not going to happen. It's just not. You're dealing with numbers that are too big, and you're dealing with numbers that are too unpredictable. Now, again, I welcome rebuttals here, and let's look at math and let's do this together. And anyone who thinks that I'm wrong, let's hook up on this. I'm not coming at this from like a negative. I don't think anyone's trying to be negative or even necessarily misleading. I just think that making videos about retiring early with tons of money for doing nothing is a really great way to get tons of subscribers. If I cared about having a ton of people watching, or I wanted 1 million subscribers, I would be begging people to subscribe. I would be making clickbait. I would be talking about how to make $1 billion with a $200 start. All of that is fake. It's all a fraud. At worst, it's completely fraudulent. At best, it's people who don't do this for a living and really don't know what they're talking about, right? I've got a professional certification behind me for alternative assets. I have professional certifications in capital markets and market structuring. Like, I'm not claiming that I know more than anyone. I probably don't, actually. But at least I can show you how I'm doing it for real, looking at the numbers, understanding the risk, looking at the deviations, and still it's tough to do it because markets go up and down in wild ways. And it makes for a good video. It makes for a good tweet when you talk about how I retired at 23, making $400,000 a year by selling put options. What that person didn't tell you is they might have inherited $20 million and they only make $400K a year on that $20 million. So it's like there's just a lot to consider here. And I also think, as a final point here, what I really, really, really want to call out is everyone is a genius when the market's going up. Okay, if you sell puts in a bear market, you can show income forever, indefinitely. Now, granted, you're probably missing triple the money by just playing long, but that said, you can look like an absolute genius. Transparency and clarity in down markets, in neutral markets, in volatile markets, this is where professionals are created and learn. And then when it comes time for the bull markets to come back, that's when they execute at scale and have the money, the capital, and the know-how to really make wealth, really generate true wealth. So with that said, thanks so much for watching. Feel free to laugh at my ridiculous trades here and the fact that I'm going to get spanked on Monday with yet another boatload that I have to deal with. But this has been really good and really fun. And to be frank, I still think I'm going to hit the 100K by the end of the year. I'm just thinking about the level of sizing I'm going to have to start to shift on, and also where I can deleverage some of the risk in trades by up-levering some of my position sizing. I'll talk about that too in the next couple of videos. So everybody, thanks so much for watching. I hope you're enjoying this. If honestly, if this is complete crap, you're getting nothing out of it, and there's something you'd rather have, feel free to let me know too. You're not going to hurt my feelings. So thanks so much, everybody. Thanks for watching, and have a good rest of the day. Bye all.